Hi, everyone. Today I'm going to be showing you how to completely restructure the way you look at and the way you do your finances. We're going to be going through a couple of different concepts, and then I'm going to show you a roadmap towards wiping out debt, paying off bad loans, completely restructuring the way you do your finances. All right. Now we're going to explain this in a couple of different steps, so try to bear with me because this is against traditional thinking. All right. But whoever won in life doing what everyone else was doing. All right. So I'm going to share my screen. You know what? Actually, I'm going to draw this out for you guys because I really want you to see this. Me and my wife have used this concept in a lot of different ways to pay off a total of 22 properties in just 3 short years, and we're looking to do more. One of our intentions when we got into real estate was to create a cash flow based retirement plan. And after exploring real estate investing, I realized that we could retire if we just followed certain steps. We could retire in the next 5 to 7 years instead of waiting 30 years. So this is one of many just mind-blowing concepts that we have been implementing. So let me share my desktop now. And I'm gonna actually draw this out. So let's get after it, guys. So concept number one is you understanding the way interest really works. So what I'm gonna do, and let's do this, get my video here. So concept number one is really understanding the difference between simple interest and amortized interest. So over here, let's write amortized. Okay, and I don't know if I spelled that right or wrong, right? What, who cares? I'm still making money. So, so there's amortized interest, and there's what we call simple interest. Simple interest. Okay. Now let's do a compare and contrasting of amortized interest and simple interest, because I really want you guys to get this. So let's say amortized interest, for this example, let's say it's at 6%, and simple interest is at 18%. Okay. And I would ask you guys, which one is better, amortized or simple? Now, because the number 6 is smaller than the number 18 doesn't necessarily mean that it's better. Let me explain. So first, we got to understand products that the banks offer that give you amortized interest and products that give you simple interest. All right. Amortized interest are things like car loans, home loans, student loans, personal loans. Okay. So you got to understand this about amortized interest products. Number one is the way the loans work is they're typically scheduled payments. Okay, so if you got an $1,800 payment at the beginning of your home loan, it's going to be an $1,800 payment at the end of the home loan. Okay, the other thing to understand about amortized loans is they are what we call front end loaded. And what that means, guys, is in the beginning of a loan, you're paying a lot of money in just interest. And I'm going to show you a visualization of what that looks like shortly. So they're scheduled and they're front end loaded. So let's talk about an amortized loan. Let me give you an example. So let's say we've got a $300,000 loan, $300,000 home loan, and let's just say it is for 30 years at 6% interest. Okay, 30 years for 6% interest. And let's just say you've been paying your home loan the traditional way, sort of how you do it now, and you've paid it down $15,000. Like, you went to work, you paid your bills, you went to work, you paid your bills, and you just paid your mortgage out of, I don't know, maybe your checking account. So you've paid it down $15,000 the traditional way. So now what is it? You owe a total of $285,000, right? That's what you owe on your loan. Do you guys have any idea how much you paid the banks just to pay down the mortgage $15,000 if you did it the traditional route? Any idea? I've done the math and I'm going to show it to you, right? You would have paid at 6% interest, you would have paid the banks somewhere around $66,000 to borrow $15,000. Does that make sense? So if you just were paying it the way you're paying it now, a $300,000 loan at 6% interest, you would have paid the bank somewhere around $66,000. So that's a lot of money that you're paying the banks to pay down just $15,000 in principal, right? Now, when I really started to understand this, I was like, whoa, that's a lot of money. You got to follow the math, my friends. The math will never lie. So let me pull up a mortgage calculator and give you guys an example of me plugging in these numbers, okay? So let's say this is Carl's mortgage calculator, and I've already put in the numbers. So we've got a property value of $300,000 at 6% interest and for a total of 30 years. Now, the image you see here is it exemplifies, the red exemplifies what you would be paying in interest, and the blue is principal. But what's really important to see, guys, and you should look at this with every loan that you use, right? I'm not saying loans are good or bad. I just want to have you understand. So let's look at the full amortization schedule on this $300,000 loan for 30 years at 6% interest. So when you look at it, this is the way it's broken down, guys. And especially when I said front end loaded, in the beginning of the loan, you're paying more interest, right? In this example, you're paying $1,500 in interest and $298 of principal. But the payment stays the same throughout the whole loan. Does that make sense? So there's interest and there's principal, there's interest and there's principal, there's interest in the principal, but the payment stays the same, a little under $1,800, right? Now you've got a balance of $299, $299,000, because I didn't put the fact that maybe you would have put a down payment, because I just want you to understand the concept. Now, let's say you paid this loan all the way down to $285,000 the way you do it traditionally. And what I did is I just added up all the numbers. I added up all of the monthly payments that I would be paying in just interest. And when I added them up, I came to around $66,000. Okay. And that's what amortized interest is like. Now, let's talk a little bit about simple interest here. Let me go back to my screen. Okay, so you guys now understand amortized interest can be very, very costly, but it's like, hey, there's no other way to do things. But there is. All right. So now that we've explained amortized interest, let's talk a little bit about simple interest and what it's like and where you can use it. So in this example, we had 6% interest. And just for argument's sake, I said simple interest at 18%. So how is simple interest calculated? Let's talk about that first, right? Because I really want you to understand concept number one. So first, you got to see that simple interest is what we call non-amortized. Amortized. Okay, it's non-amortized. Number two, or the next thing to understand is it's recalculated. It's recalculated every single month. So let's see. So we borrowed $15,000 on the amortized side here. So let's use that same number. Okay, so how do we calculate simple interest? So you take whatever you owe. So let's just use $15,000. Okay, $15,000 is what you owe. And how would I calculate that? Well, let me teach you guys. You take what you owe and you multiply it by 18%. Right? 18%. And there is 360 days in the bank's fiscal year. Okay. So you do 15,000 times 18% divided by you times 18% divided by 360, because there's 360 days in a bank's fiscal year. And then you multiply that by 30 days. Okay. And that'll give you what you're paying to borrow $15,000 at 18%. So let's do it in a calculator. Let me pull it up. Let me just pull it on up. Pull it on up. Okay. So hopefully you can see my calculator here. So this is exactly how you would do it, guys. Share my desktop. So you got 15 $1,000, okay, times 18% divided by 360 multiplied by 30. As you can see on my screen, you're going to pay $225 to borrow $15,000. All right. So let's go back. Let's go back here. All right. So to borrow $15,000 at 18% is going to cost, because we just calculated it, $225 a month. Okay. Now here's the question. Well, before we get there, so $225 a month to borrow $15,000 at 18% interest, where if you just paid down $15,000 or you borrowed $15,000 at the amortized interest, it costs you $66,000. You guys starting to see that there's a major difference between how these two are calculated. All right. Now, let me show you what I mean by when I say recalculates. Okay. Now, let's just say you get $1,000 and you pay it towards the $15,000 that you owe on the simple interest side. So you do the same thing, everyone. You take $14,000, you owe $14,000, you multiply it by 18%, and then you divide it by 360, and then you multiply that by 30, because there's 30 days in a month. And what you're going to get, and I'm just going to do it off the top of my head. You could do the math and let me know, but you're going to end up paying like $210. Does that make sense? So what I want you to do is just imagine that it doesn't even recalculate. Imagine it just stays the same. Let's just take $225,000. I'm sorry, $225. And let's just say you had $1,000 every single month, and you were paying this $1,000, $1,000, $1,000 until it would take 15 months to pay it down. So what's 225 times 15? I don't know. Let's do. I'll just use my calculator. 225 times 15. So $3,000-ish, like 3 G's, $3,000, right? So here's the question. It's like, would you rather pay $3,000 to borrow $15,000, or would you rather pay $66,000, right? Step one in restructuring your finances is understanding the major difference between the way amortized interest is calculated and the way simple interest is calculated. All right. So now that we've got concept number one under our belt, let's clear all of this. Okay. Now let's talk about concept number two, and just bear with me. Okay. Concept number two. Concept number two is this, is understanding the difference. Let me go through my notes because I want to stay organized. Is understanding the difference between your checking account, and a line of credit. Okay, we use line of credits creatively in the business world. All right, so let's talk about this. So typically, let's just draw a line down the middle. So you got your checking account. Okay, and when you get paid, money goes into the checking account. Or money goes into the checking account, and then money goes out, and then you got your, maybe you got your pocket. Okay. So this is the way a checking account works. Okay. It is what we call a revolving account. Money goes in, money goes out, money goes in, money goes out. Okay. Functionally speaking, what about a line of credit? With a line of credit, if you have a line of credit, it could be for 100 grand, 50 grand, 20 grand. If you have a line of credit, money can go out, money goes out and into your pocket, and money can go in, right? They're very similar. They're so similar that what if I stopped using a checking account and just used a line of credit for my finances? Right? This is what I've really started learning to do. So I just wanted to explain to you the similarities between a checking account and a line of credit. Okay. Now let's go into a real life example and show you how understanding these concepts can be so powerful for you and your family's finances. So let me clear all of these and let me give you, I've taken some notes and let me draw this out for you guys. Okay. So concept number 3 is a real life example. Okay. So let's do this. Let's say you've got, and we're going to stick with the same thing. You've got a family, and the family brings in, just for example, everybody's numbers are different, but this family brings in $5,000 every single month, and we'll call that income. Okay. Now, this family also has $4,000 of expenses, right? Like their cell phone, their mortgage, food, fun, all that stuff. So they've got a budget. They've got $5,000 of income and $4,000 of expenses. Okay. Now, in this example, the family every single month they're going to have $1,000 left over, and that's called cash flow, right? That's your cash flow. That's what you got. Now, let's say that this family has a home loan. Let's stick with the same thing. Like this family has a home loan for $300,000, right? That's the home loan. That's what they owe on their home. And we're going to stick with the same numbers, 6% interest for 30 years, okay? But at the same time, let's say this family um, has a line of credit. Okay, it could be a home equity line of credit, it can be a business line of credit, it could be a personal line of credit. Heck, it could be a credit card because credit cards are lines of credit. But let's say they have a line of credit, and for argument's sake, that line of credit is still at 18%. Ooh, right? 18%. And let's say you have a line of credit for $25,000. Okay. It could be more, it could be less, but 25 G's. Okay. But remember, this line of credit, I've just transitioned. I call it my new checking account. Okay. Now, family has fixed income, fixed expenses. You might have fixed income, fixed expenses. What's to say we don't take, I don't know, let's say we took out of this line of credit, we borrowed $15,000, and we took this $15,000 and we paid it towards the principal of this loan, right? Just depends on how you want to apply it. But I just took $15,000 and I paid it towards the principal of this amortized loan, okay? By me showing you the math earlier, right? If I took 15 grand and paid it towards the principal of this loan, so 300K minus 15K, you have a principal balance of $285,000, right? So your debt has not changed yet. You still owe, right? You still owe $15,000 on this line of credit, and you've just paid down the principal of your mortgage. But you know, because I've shown you the amortization schedule, by paying down $15,000 of principal, you now know that you've saved $66,000 of interest that you would have paid the banks if you just continued to pay it the traditional route. Does that make sense, guys? I hope it does. Now, look, we know that this family has $5,000 of income and $4,000 of expenses. So what's going to happen is we've got this line of credit for, we've borrowed 15 grand, right? So when our income comes in, we're going to say $5,000 comes in. Okay. So when the $5,000 comes in, it's called an income, right? And when it comes in, if you take that 5 grand and you pay it into the line of credit, the bank's like, thanks for the payment. We appreciate you. Good doing business with you. But right, you've got that income that goes into the line of credit. But for this example, there were also $4,000 of expenses. You just pay them out of one account. This is a way to simplify your life, right? One account. You don't need to make it confusing. So $5,000 comes in, $4,000 goes out. But remember, what happens is there's $1,000 of cash flow left over every single month. Okay. Now, with this family's budget, and every family's different, with this family's budget, if they had $1,000 left over, instead of just putting it in a savings account where it's devaluing because of the rate of inflation, they're just rethinking how they use their money. So $1,000 stays in the line of credit every single month. So logically, it would take 15 months to get this line of credit back to $25,000. Does that make sense? Because income goes in, expenses goes out. Income goes in, expenses go out. But every month there's $1,000 left over, right? So logically, in 15 months, this line of credit will have no balance, right? But what would you do when it doesn't have a balance? Guys, the logical thing to do would be to take another $15,000 and pay it towards the principal of the loan. Now, in this, and I've done the numbers, this time you're going to save somewhere around $40,000 in interest, right? But you're drastically paying down your amortized debt. You're building equity that you may be able to leverage later, and I'm going to talk about that. And you're saving thousands of dollars. Guys, I want you to pay attention to this. If you just did this process over and over and over and over, you could pay off your house in the next 5 to 7 years without you paying any extra money out of pocket. This is just restructuring, my friends, okay? And it's learning how to save thousands of dollars on the amortized side by understanding how powerful the simple interest could be, right? This is financial restructuring at its best. So what I'm trying to show you, if I just did this process with this existing income and expenses, in 2.5 years, the family would have saved a total of a little over $100,000 that they would have paid out to the banks in just interest. It's like we got to start thinking bigger when it comes to our money and our finances, right? It's all about quality of life. Okay, now you may be a little bit confused, and there's lots of ways to implement this strategy, and everybody's finances are different. So what we've done is we've put together all of the resources and tools, all of the spreadsheets and calculators to help you run your numbers, because when you're new to this, it could be a little bit confusing. All right, so we covered the way interest works, amortized and simple. We covered, instead of putting your money in checking accounts, maybe putting them into your line of credit, depending on your situation and circumstances. And then we covered using simple interest to dramatically pay down amortized interest without you spending any extra money out of pocket. Now let's drill down on this a little bit more. All right, I've got one last step. So concept number 4, right? Hopefully you guys are still with me and I didn't dramatically confuse you. So let's talk about concept number 4. So here's concept number 4. You guys ready for this? So let's stick with the same thing. So concept number 4, all right? So let's say we've had this $300,000 property, okay? And we've been using the process that I just showed you, restructuring finances, leveraging simple interest to retire amortized interest fast, okay? After a while, you're going to create equity, right? It's just natural because you're building equity. So let's just say we've paid down this $300,000 loan $175,000 by doing the process I just taught you, okay? So you've paid it down $175,000. So you have a principal balance of $125,000, all right? You owe 125. Now, what's to say that you don't go out and get what we call a home equity line of credit, right? So you've paid it down 175. You have a principal balance of 125. So what you have, guys, is you have $175,000 of equity. Well, what's amazing is the banks will typically allow you to borrow, 70, 80, sometimes even 90% of the equity that you have available. So what's to say you go out and get a home equity line of credit, a HELOC, for $150,000. Okay. Now, what if, and I've done this, right? What if you took this HELOC and you just paid off the balance, right? Now you have a $150,000 HELOC, okay? But what just happened, guys? Well, your mortgage payment went away. You don't have a mortgage payment anymore. So your cash flow actually increased. Does that make sense, guys? Because you've paid off your mortgage. You've paid it off with this HELOC. So now it's like a first position HELOC. And there's lots of different ways to structure this. So now, guys, your finances are going to stay the same. Your finances aren't changing, right? So you got a $150,000 HELOC and you paid off a $125,000 loan. Okay. Now remember, everything stays the same. Remember, you had $5,000 of income and you had $4,000 of expenses. But the only difference is because your payment on this loan, it used to be $1,800. Because you no longer have to pay that, your income, what happens to your income? It goes up, right? It goes up. So it's the same process that you're going to go through. Now, I want you to understand this. The rate of your cash flow dictates how fast you can really make this process work for you and your family. But the idea, guys, is the idea is not even to completely pay down all your debt, right? Because sometimes, depending on your business model and what you're doing and what phase you are at in life, you may not want to pay down all your debt. Like I have a 50-50 blend, meaning 50% of my portfolio is paid off and it's just cash flowing. And some of my portfolio, I actually leverage debt to get rich. What do I mean by that? So I have mortgages on lots of rental properties, but after all of the expenses are paid, after all the expenses are paid, those properties are still producing me cash flow. Does that make sense? So I'm like, why don't I just let my tenants pay off my assets and just live off of the cash flow? I was like, man, this is such a good idea. And so I've been doing a similar process the last 5 years, and we've been able to produce a revenue stream. You know, we're making close to $30,000 a month before we even get out of bed. And this is a kid that started with no college degree. I'm dyslexic. I can barely spell. I don't know how to do math, but I started understanding the rules of the rich. And by understanding these rules, I've restructured my life, my finances, and really, I'm not a flashy guy. I just absolutely love freedom. I'm a freedom junkie. I don't like being controlled. And I wanted a systemized way of paying down debt that needs to be paid down, and a systemized way of creating cash flow to live my best life. Okay, I know I gave you guys a mouthful today, and this video has ran probably pretty long, so I'm gonna leave you with this. Well, actually, let me just say this. I want to exemplify what I'm doing, right? So as you start paying down properties, and I really love investing in cash flow markets. Those are my notes here. Let me show you an idea of hypothetically what I'm doing, right? So as you start building equity and you have cash flow, you have money, you have lines of credit, you have cash reserves. What I've been doing is I will go out and buy a house, cash with my lines of credit, okay? But every time I buy a house and rent it out, it produces more cash flow. Does that make sense? And that cash flow increases my monthly income, okay? And then once I have some other debts paid down, or, you know, depending on what I'm doing with my businesses, I'll buy another house and that'll produce more money. And then I'll use the same process to pay these houses off. And then I'll buy another house and it'll produce more money. So it's sort of like you start, instead of being in debt and doing your finances one way, you start creating an income snowball where the more assets you buy, the more income it creates, and the more income it creates, the richer you get. And it's like, wow, I want to introduce this to other people and actually help them do it, because it could end up saving hundreds of thousands of dollars and allow you to live your best life. Guys, thank you for attending the training. I'm glad that you now understand the difference between simple interest and amortized interest in just one of the many ways you can completely restructure your life, your finances, and how you feel, right? Thank you for watching again. If you have questions, call, text, email. My information's down below, or you can even just call me. My cell phone's 571-344-9483. Have a great day. Bye now.